Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you the private equities diverging paths and how Blackstone, KKR and Apollo are charting different courses for the future. For decades, Blackstone, KKR and Apollo rose together, riding the same wave of leveraged buyouts and building massive empires of third-party capital. But the past 5 years have marked a striking divergence that's reshaping the future of private capital and offering investors a front row seat to high stakes strategic experiment. Now, when we are talking about Blackstone, it has emerged as a traditionalist. Now, Blackstone, the largest of the three, has doubled down on the fee based asset light model that manages other people's money in exchange for predictable fees. This approach is that of an asset light manager of third party capital with minimal net debt and no insurance liabilities. Blackstone argues that this model brings transparency, flexibility, and resilience in a downturn, benefiting from a net surplus of $7 billion in cash and investments. But this model also means that Blackstone must continually raise new funds even when the markets are volatile. As private equity's fundraising environment tightens, the pressure to attract capital could test Blackstone's ability to maintain its growth trajectory. Let's move on to Apollo, the insurance giant. Now, Apollo has taken a radically different route to building a symbiotic relationship with its life insurance platform, Athene. With more than $395 billion of assets, mostly tied to insurance liabilities, Apollo is essentially operating like a bank. Its assets leverage ratio rivals that of JP Morgan. This model grants Apollo long-term capital and fee streams while also enabling to originate high-yielding loans to blue-chip borrowers like AT&T and Sony Music. However, this approach introduces complexities, policyholder liabilities, exposure to interest rate risk, and heightened regulatory scrutiny. However, Apollo sees this as an opportunity to make every asset more profitable, hedging against an environment wherein good deals are scarce. And this brings us to KKR, the conglomerate builder. KKR has also embraced an insurance-centric strategy, acquiring a majority stake in Global Atlantic, but has taken diversification even further. Its conglomerate approach uses retained earnings to buy and hold a growing portfolio of operating businesses aiming for long-term compounded growth. This model, reminiscent of Warren Buffett's Berkshire Hathaway, offers potential for steady dividends and diversified earnings streams. But it also exposes KKR to valuation risks if market conditions sour, just like any other operating company. Indeed, KKR shares fell harder than those of Blackstone during the recent market shocks, underlining investors' concerns about the balance sheet-heavy strategies. This brings us first to why does divergence matter? The divergence highlights a fundamental tension in the private equity today. Should firms remain capital light, focusing on predictable fee income, or should they embrace a capital-heavy strategy that promises higher yields but comes with bank-like risks? Blackstone argues that its model is more transparent and adaptable, allowing it to pay out steady dividends to investors even during storms. Apollo and KKR bet that the insurance-backed models provide stable long-term funding, even if it means managing complex liabilities and regulatory hurdles. As interest rate fluctuates, deal flow tightens, and investors scrutinize risk, these strategies are likely to be tested in ways that they haven't been tested in decades. Now, as they wrap up this video and this particular topic, let's look at the big picture. This is more than just a tale of three titans. Their choices will influence not just investors but also the broader shape of the private capital itself. New entrants like EQT, CVC Capital, and even BlackRock face the same strategic crossroads. Do they lean into conservative capital-light Blackstone model or embrace the insurance-fueled strategies of Apollo and KKR? Now, at a time of slowing exits, tougher fundraising, and uncertain markets, the stakes could be higher. Now, that's all that we wanted to share with you in this particular video. Hope you have enjoyed this video. Do stay tuned in for more.